We're discussing bankruptcies, Chapter 11s, and Hertz coming up. What's up, guys? Today I'm going to talk about what happens when a business files for bankruptcy. We're going to talk about a Chapter 7 and a Chapter 11, but if you want to skip to the part about Hertz, I'll leave a link in the description below like I always do. If this is your first time here, welcome. My name is Sean. Here I'm documenting my journey to financial freedom, and I talk about saving and growing money. So if you're into personal finance topics, please consider joining us by subscribing. Speaking of us, we actually hit 150 subscribers on this channel, so I just wanted to say thank you to all the new people who've subscribed to the channel. It took a long time to get to 100, but we got our last 50 subscribers in about a month, so that's amazing. Thank you. All right, without further ado, let's talk about types of bankruptcy and why they go bankrupt. Well, there are different types of filings you can have for bankruptcy. There are Chapter 7s, Chapter 9s, Chapter 10, 11, 12, 13, and 15. However, only two of those apply to businesses, which are Chapter 7 and 11. So that's what we're going to focus on today. The reason a business usually files for bankruptcy is they have one or more of three of these problems. Either there's issue with liquidity, which means their access to cash. So if a company falls on hard times and needs cash, they would usually sell an asset to get some cash. If the company has a hard time selling assets, they have a liquidity issue. Second would be a solvency issue, which would mean that the company has more liabilities than assets. And again, in an emergency, if it needed to cover all of its liabilities, it would not be able to. And finally, there's viability. And viability just means the ability for the company to be profitable. And that doesn't necessarily mean they're profitable every quarter, but that means that over the long term, the company does turn a profit and they have access to some cash and credit, which is, again, a good thing for liquidity. So if a company has one or more of these issues, depending on how bad it is, they will file for bankruptcy, and it could be either a Chapter 11 or a Chapter 7. Let's talk about a Chapter 11 first. A Chapter 11 involves notifying the government and reorganizing your business. You can continue to run the business in the meantime, but you're going to be restructuring your debts and assets in an effort to make the company profitable again. A committee is actually brought in by the government in order to help with the restructuring and make sure that the plan actually would get the company to be viable again. A plan is then submitted to the government that has to have the creditors' best interests in mind, and during this time, the company has to notify the government if there are any major transactions like buying any assets or going into any other major contracts. As part of the restructuring, the company is most likely going to cancel all of its shares and later issue new shares that are at a much lower value than the current ones. Now, if the restructuring doesn't work, they may end up filing for a Chapter 7. In a Chapter 7 scenario, the business has no intent to keep running. So that's a big difference from Chapter 11. Chapter 11 is restructuring, but Chapter 7 is basically liquidating all your assets and paying off all your creditors. The government appoints a trustee, and the trustee oversees the liquidation. They sell off everything that the business owns and then puts the creditors in line to get paid. First, they make sure the government gets paid any taxes that are owed. Second, they make sure secured creditors, which means creditors that have a lien against any type of property from the business, are paid. If this was you, it would be like your mortgage, like the bank is a secured creditor for the mortgage on your house. The house is the property. Next come unsecured creditors, which are creditors like credit card companies. They don't have a claim to anything that you own, but you still owe them money. For a business, this would also include preferred shareholders and bondholders. And then, if there's any money left, they may distribute it to the shareholders. However, you can bet that this is going to be way less than what the share price is at that point. So now you can see why there's a big sell-off and drop in stock price when a company files for bankruptcy. The chances of you getting your money back are next to none, so people say, well, I'm just going to cut my losses and put my money somewhere else, because the best case scenario would be a Chapter 11 filing that takes a long time to sort out, and you would just have shares at the end of the day that are worth less than what you put in anyway. Oh, and another big important point is no dividends are paid during the process in either scenario. You don't get dividends after a company files for bankruptcy, as they're driving all of their cash towards paying off their creditors. So let's talk about Hertz, which has been in the news lately because it's filed for a Chapter 11 bankruptcy. Carl Icahn, who's also a big investor, has sold all of his shares in Hertz. He was a major stakeholder, and he sold them at a loss. I also talked about Hertz in a previous video, which I'll leave a link to right here, when I talked about businesses that were more adversely affected than others by this whole, virus. So Hertz is filed for a Chapter 11, but how did it get there? Well, one of the things I say on this channel about recessions is that the companies that have a lot of cash and liquidity are able to weather the storm and get through these, especially if they're short. What we have here, I think, is a case of too much debt. Right now, let's dive into the Q1 earnings of 2020. You can see that Hertz ended Q1 with $1.4 billion worth of cash and cash equivalents and $20.6 billion in debt. And as you can see from this chart, this is long-term debt, and that debt has been climbing for the last several years. At the end of 2019, the debt to equity ratio was 10 times. And then of course this happens, Hertz closes all of its locations, so no cash is coming in. And now the debt to equity ratio is actually almost 14 times. So let's talk about some of the stats you want to look at when you're evaluating a company who's in trouble like this. You want to look at these for most companies anyway, but here we go. So obviously we talked about debt to equity ratio. There's the current ratio, which is the current assets that it holds over current liabilities. So this is the viability of the company. You may also want to look at a debt to asset ratio, depending. And you might want to look at book value as well, which indicates assets minus liabilities. At the end of 2019, this was $1.49 billion for Hertz. So in summary, it looks like here that Hertz has kind of a cash issue or a liquidity issue. They've been running up these high levels of debt. Now because of the beer problem, they've had to shut their doors and no cash is coming in. To a household, this would be like buying a big house that you can't really afford, having some credit card debt, losing your job because of the beer problem, and then not having an emergency fund to float you through that difficult time. You then file for bankruptcy, a trustee comes in, they consolidate all of your debts, and they start liquidating your assets. First, they'll make sure that you're paying your taxes. Next, you owe your secured creditors, which would be like the bank because you owe them for your house. Next, you owe the credit card companies, and then we'll see if there's anything left over for you to live off of. This is why liquidity is so important for businesses and emergency funds are so important for people. Okay, you know what? Screw it. By the way, guys, if you're liking this video, please remember, hit that like button and subscribe and hit the notification bell to know when new videos are coming out. So now on this channel, I'm always looking for undervalued companies to invest in. So would I buy Hertz right now? Is there any money to be made in a company that's going bankrupt right now? Well, the short answer is probably not. And the reason is because Chapter 11 filings just take a long time to sort out. Best case scenario, you're going to end up losing your shares and then being given shares that are worth less money anyway. However, there might be one opportunity depending on the timing. Companies that file for Chapter 11 bankruptcy can come out of it leaner and meaner than they were before. And because everyone is still reeling from the fact that they filed for bankruptcy, they may be able to come onto the market at a good value. Those new shares are worth less than the old ones, and then be able to run a viable business that's worth more in the future. So there's nothing wrong with putting a company that is filing for bankruptcy maybe on your watch list, just to keep tabs on them in the future to see what they look like when they come back. So what's next for Hertz? Well, they're going to be taken off the New York Stock Exchange. They don't qualify to be on there anymore. The stock did get a slight bump up last week. That's kind of sending mixed messages. I still wouldn't go in and buy any shares of Hertz. They're going to be putting together their restructuring plan, following it, keeping the government in the know. So it's just going to be a while till we see anything profitable or anything exciting from Hertz at this point. Well, guys, that is my take on Hertz. Again, I'm not a financial planner. That's just my opinion, but I won't be investing in them in the near future. But I hope you guys have found this video useful. Again, if you have, please hit that like button. That would be very much appreciated. If you have any comments, of course, put them in the comment section. Let's talk about it. And until next week, have a great week, spread the wealth, and I'll see you in the next one. Bye.